Welcome to the Earn Your Marks podcast, presented by Pro Exam Tutors, the only podcast you need to pass the CFP exam and become a certified financial planner professional. Here's your host, Sev Maneshian.
Well, welcome to the Earn Your Marks podcast. I'm Sev Maneshian, certified financial planner practitioner, lead tutor, and the founder of Pro Exam Tutors. Now, in this episode, I'm going to be talking with a couple of bona fide Social Security experts. Now, of course, there are Social Security experts out there, but guess what, guys? These two gentlemen teach and certify the experts, so they know more than a thing or two about Social Security, which there's no question, no doubt about it, you will be tested on the CFP exam. Okay, now, in fact, my guests today created the Social Security Advisor Certification education industry back in 2013. Marc Kiner and Jim Blair are the co-founders, and there's Mark and there's Jim. And just by chance, we did not talk about this beforehand. We're all wearing blue. I think Mark and I have the same shade, and then Jim, you've got the shade of blue of the Little League team that I coach. So I don't know if the stars are aligned or something, but Mark and Jim created and are the co-founders of Premier Social Security Consulting, and they provide customized consulting for individuals or couples reaching their full retirement age, and also help them with understanding and maximizing their lifetime Social Security benefits. That's on the retail end of things. They also provide Social Security education and training for all types of professional advisors who are looking to increase the value of what they bring to their clients by answering the questions they have about Social Security. So, you as an individual or as the branch, if you want to bring these guys in and looking for certification, they are certainly the guys to talk to. Now, I'm going to just go to the two individuals here before we start talking about some exam-related topics. As for Mark, he has 35 years of experience in public accounting. Okay. So that's quite a few years, and his primary area of service was to privately held businesses and individuals, and then he recognized the need in the marketplace for enhanced advisor knowledge for Social Security filings, which we know can be a little bit complex when it comes to the overall financial picture. Mark sold his practice in 2012 to concentrate on Social Security. And I didn't mention that he's also the co-founder of the National Social Security Advisors Certificate Program. So that's on Mark's end. If we turn to Jim for a second, he's the lead Social Security consultant at Premier Social Security Consulting. He also has over 35 years of experience helping individuals manage their Social Security benefits. And I want you guys to listen to this part really carefully. Jim retired after 35 years with the Social Security Administration, and he's also the co-founder, along with Mark, of, as mentioned before, National Social Security Advisors Certificate Program. So, gentlemen, how about that introduction? Did I cover all the bases?
Well, you didn't make too much of that up, Sev.
No,
you forgot to discuss my Harvard law degree, but that's okay. We'll pass that by for now.
We're gonna leave that part out for now, I suppose. So
yes, but appreciate it, Sev.
Definitely impressive backgrounds. And Mark, when I reached out to you, it was interesting that it was initially, I believe, I have a financial planning practice as well. So I had a client that had a question, I believe, about delayed retirement credits. And he's also a government worker, a police chief, in fact. So he had questions about his wife pulling in benefits. I think you kindly answered the question for me on LinkedIn. And then some time went by, and I said, you know what, these are the guys I want to talk to help out the students out there, because Social Security is a part of the CFP curriculum and the exam. So, I guess we can start out. If you don't mind, either of you, a little bit about your background, which we touched on, but how your company started, as why it started, and how you help not only the public but also professional advisors.
Well, I tell you what, Sev, we talk about that at the beginning of all of our full day classes. So let me tell you how Jim and I got together.
Okay.
As a CPA, and as I was getting a little older and losing a little more hair, I was getting more questions from my clients, tax clients, about Social Security.
Okay.
I did not have the knowledge to help them. So I thought I would offer Social Security consulting services in my accounting practice. So back in 2008, I bought 3 books, read them cover to cover. I ended up with more questions than answers. So I knew I could not provide Social Security consulting services in my accounting practice.
Okay.
One day, I was in a local restaurant called the Rusty Bucket. It's kind of like a TGIF nationwide.
All right.
And an attorney walked in, somebody I'd known for about 10 years. And on a hunch, I went up to his table and I said, do you know of anybody who could educate me about Social Security? Well, he told me his uncle works for the Social Security Administration and his uncle is going to retire a few months later. So you know by now, his uncle ended up being my partner, Jim Blair.
Okay. So I didn't, that's what a chance.
It's complete fate that we're on this podcast with you. I had to have an interest in learning about Social Security. I needed to be at that restaurant. I needed to walk up to this individual and ask him. He needed to tell me about Jim. I needed to contact Jim and talk to him directly. Believe me, in many areas that all of that might not have happened, but it did.
That's a say before, we're wearing the same color shirts as if the stars are aligned for some, and then back then, what are the chances? So that's pretty.
Yeah.
Okay, so you two got together. Jim, you were still at the administration when you met, or had you retired or just retired? I forgot that part.
I had not yet retired. I was a few months away, about 3 months or so away when we first met. And, at that point in time, that's not what I was looking to do. My focus was to retire and go fishing. Okay. But, you can't fish every day because sometimes it gets cold outside.
Sure.
So we talked a couple of times, and you have to do something in retirement. That's what I know. I want to make sure that people understand what benefits they're eligible for and get what they're entitled to receive. So what better way to do it than at the beginning we were talking with people about their benefits, and now we're teaching financial advisors, CPAs, insurance agents all about Social Security, because if you deal with any type of money at all, people think you know everything about everything, and they're going to ask about it. So even if you don't remember everything we taught you, you know where to go to get the answers. So it turned out to be pretty good. We've been doing this since 2010, and it's worked out real well, I think, for both of us.
Well, not bad. So you're teaching the teachers, or I should say you're teaching the professionals. Yeah. And then the professionals are turning around and sending that information out to their client or advising their clients on that. So I'd have to imagine you both know. Well, I don't have to imagine this. I know the ins and outs of the Social Security and claiming and certain strategies. But I wanted to start with a little bit maybe more on the technical end, because on the CFP board exam itself, the students have to know things like, how are benefits accrued and calculated. So in a nutshell, can you just explain for the listeners how benefits are accrued and calculated? And do we have to work a certain number of, is it years or quarters? Do we have to earn enough in a year? Like how are those things calculated?
So Jim, I'll answer the first part of the question about who qualifies. Okay.
Sure.
Okay. So in order to qualify for retirement benefits, a couple things. You need to have, of course, we all know this, you need to have 40 credits. Okay. 4 credits per year means it takes you about 10 years to obtain 40 credits. How do you obtain a credit? Do you have to work in each quarter? No, you have to have earned income. For every $1,560 in earned income, you get 1 credit. I'm hoping I'm right on that figure. Am I right, Jim?
That is correct.
Okay. So let's just say you earn $7,000 for the year. Then you get 4 credits and you're good for the year. You could earn. Go ahead.
Theoretically, I mean, if I'm making $10,000 a month, I could earn those 4 quarters, and I'm done for the year after one pay.
That's right. You can make $25,000 in January, not work another day the rest of the year, and get you 4 credits. So it's called credits. It's not called quarters. Just so you know.
Okay.
Even though if you read some stuff on the Social Security website, for example, they come out with their COLA fact sheet each year. They refer to this as quarters and not credits. So they even get it wrong.
Okay. So it's like saying Xerox and copier almost. I'm going to make a Xerox copy.
Fair enough. So you need 40 credits. The second
you did say, Mark, how much did you say? How much did you say?
How much is it?
1640.
1640.
We got you. This is a pop quiz. You didn't even know it.
It must have been 1560 last year. So
okay, right. 15. That was 1510 the year before. So 1640 this year. We know it'll go up next year a little bit.
1640 per for every 1640 that you earn, you receive 1 credit. Thank you, Jim. I appreciate it. So if you're $7,000 or so, I should have said or so, you would have you get all 4 credits. So 40 credits. And then the second requirement, you need to be at least 62. You have to be the 62 for the entire month. So if I was born February 13th, so I turned 62 February 13th of 2018.
Okay.
I was not age 62 for the whole month of February. So I had to wait until March, at which time I was 62 and 1 month of age to have begun my benefits.
Okay. So it's not in the month that you turn.
No, 62. It can be, but for the most part, it's not going to be.
Unless it's like February 1st or something.
If it's the 1st or the 2nd, it will be the month that you become age 62.
I see. Okay.
It will be. But for the most part, though, folks will not be eligible for a benefit until they reach the age of 62 years and 1 month, like I did back in March of 2018.
Okay, so 62 is the earliest I can get a retirement. Now, is there, I mean, we'll just off to the side for a second. I mean, if we're talking about a widower, they can start as early as 60.
Yes.
But a divorcee has to start also at 62. We don't want to confuse the widow with the divorce.
So retirement benefits, age 62. Surviving spouse benefits, age 60. Unless the surviving spouse was disabled within 7 years of the deceased's death, then he or she can begin at age 50.
Okay, so we have the 3 ages, but really 62 is the
for our discussion, retirement benefits, it's age 62.
Okay.
Jim, I'll let you handle how benefits are calculated.
Yeah, they're calculated by using your highest 35 years of indexed earnings. And what that means, indexed earnings is an inflation factor is added to your wages, starting with that very first job you had when you were 16, maybe at Wendy's or McDonald's or wherever, delivering papers, whatever you were doing, all the way up through the age of 59. Now, starting with age 60, they still count those earnings, but they're not increased for inflation. So they'll take the early years of earnings, increase them for inflation. Then they'll look at all of your earnings up through the most current year, and they'll pick your high 35 years out of that. They'll divide that by 420. That's the number of months in 35 years. And that gives Social Security what they call your average index monthly earnings. So it's your average wage over your high 35 years of earnings adjusted for inflation.
Okay. And if you 40 years, let's say 40 years, but in those past 40 years, you took 5 years, I don't know, to travel the world, we would kick out those 5 zeros. So now we're just looking at the 35 highest, no matter what.
No matter what. So even if you have less than 35 years, for instance, a lot of public employees who don't pay into Social Security through their public job, like a lot of teachers or some of the older civil service folks with the federal, somewhere along the line, they worked and earned their 40 credits. They're still eligible. But when they compute the benefit, if you have 10 years of earnings, what you need to earn those 40 credits, you will have 25 years of zeros used in the calculation of your benefit. Wow. So they use 35 no matter what.
No matter what. Okay, so you could have the zeros in there. And you mentioned government employees. Just can we briefly talk about the Windfall Elimination Provision, and then what always accompanies that is the government pension offset, which if you look on the statement, it's either on page 1 or 2. Usually it'll have a little paragraph talking. I mean, it won't give a figure, I don't think, from what I recall, but it will mention something about the WEP or the GPO. So, what's the difference between the two? Is it both of those apply to the worker only, or does one apply to the worker and one to the spouse?
Well, I'll go ahead and get the discussion going. Hope I don't blow this one. Anyway, if you have a client that is a public employee or was a state worker, county worker, city worker, or a federal employee hired before 1984, there are a couple of provisions which may impact Social Security benefits: Windfall Elimination Provision, or WEP, or Government Pension Offset, or GPO.
Okay.
Now WEP applies if you're eligible for your own public employee pension and your own Social Security benefit. GPO, which we call Grumpy Partner Offset, and not Government Pension Offset, applies if you're eligible for your own public employee pension and a Social Security benefit off of a spouse. That would be off of a current spouse, off of an ex-spouse, or off of a deceased spouse. So, Jim, why don't you talk about WEP first, and I'll follow up with the Grumpy Partner Offset.
Sure. And if folks are going to be subject to this, there are a couple of fact sheets that Social Security has that you can look at. They're just 2 pages. They do a good job of explaining both of these. The WEP fact sheet and the GPO fact sheet. If you just Google that, you can find a link to those. So if you're interested, if anyone's interested, I recommend you do that. But Windfall, as Mark said, applies to folks who are eligible for a pension from work not covered by Social Security. And along the way, they earned their 40 credits, so they're also eligible for Social Security retirement benefits. Windfall comes into play because Social Security benefits are computed to give lower earning individuals a higher percentage return of Social Security benefits versus the higher earner. And the folks that work in non-covered employment, their record looks like they're a lower earner when if you take their non-covered earnings, they're not. Congress felt those folks were getting a windfall. Therefore, the Windfall Elimination Provision.
That's where we get the word from, because it'll look like, if we have a police officer or a firefighter, it looks like, if they've been on the force for 30 years, it looks like they're making really nothing or very, very small amount. So the whole system, and I can't remember the formula, even though students have to know it, but those are one of the few areas I have to refer to my notes, is that in the first $900 or so, you get a higher percentage of that replaced, and then the formula.
Right. It's
different numbers as you go higher on that scale.
Right. This year, the first $1,115 of that average wage we talked about, normally you get 90% of that towards your benefit.
That'll be replaced.
The 90% stays constant. The number does change from year to year. Well, with Windfall Elimination, what they did was they changed that, and those folks can see that percentage drop to as low as 40%. It depends on how many years of substantial Social Security earnings you have, and you can see what those are on that fact sheet. If you have 30 or more, Windfall no longer applies. If you have 20 years of substantial earnings or less, that first BIM point is what it's called. It's at 40% instead of 90%. And then the more years of earnings you have, the higher that percentage is going to go. But what it does is right now it lowers the benefit as much as $558 a month. The good news is it never zeroes out the benefit because it's just a change in that percentage. You'll never be completely eliminated. Your benefit won't. You'll always receive something. Okay. May not be what your statement says or what you were expecting, but you'll receive something. They do not apply WEP until you start to receive your benefit, and they will not reduce your benefit by any more than half of your pension. Few people get to take advantage of that. Most of the time, the pension's high enough, you get the full offset. So it does. Windfall elimination, WEP, applies to people who are eligible for a retirement benefit plus the non-covered pension.
Okay, so this is an area, let's say, not so much exam related, but financial advisor or a planner related, that if we're running a plan and we're doing a budget forecast and an income statement forecast, that we have to know that, well, I was expecting $2,000 a month, but I only might get, just as an example, I might get $1,000 a month. It won't go all the way down to zero, but if the worker was expecting a higher amount, we have to make sure that the client is aware of that. So that's where your training of the advisors comes in. I mean, that's just one small part of it. So
yeah, Sev, we cover public employee issues kind of towards the end of the day. So Jim talked about WEP. I'll talk a bit about GPO, government pension offset. Mm-hmm. So GPO applies if you're eligible for your own public employee pension and also a Social Security benefit off of a spouse. That would be off of a current spouse, off of an ex-spouse, or off of a deceased spouse. There's a 2/3 offset. You take what you can get in Social Security benefits off of your spouse, current, ex, or deceased. You reduce that by 2/3 of your state pension, and whatever is left over, you get.
Then you get the difference.
Difference. Unfortunately, fortunately, in Ohio, a school teacher might be receiving $6,000 in state pension. You take 2/3 of that, $4,000. That's going to wipe out just about every Social Security benefit you might be eligible for. Okay. And that is why we are trying to get the name of GPO changed to Grumpy Partner Offset.
Well, you might have some luck with that. So
we're working on it. I think it might even be in the budget resolution that Congress is trying to pass.
It should be. It's easier to remember because like the W in WEP is for the worker.
And
the G is for the grumpy partner.
So for those folks out there listening and watching us, if there's a question on the assessment on your CFP test asking what GPO stands for, just make sure it really stands for Government Pension Offset and not Grumpy Partner Offset. We don't want you to get that question wrong.
Yeah, well, and to give you guys the credit on it too, maybe that'll be an extra credit question, but they don't have those extra credit questions, unfortunately. Yeah. Okay, so that tackles our WEP and GPO. Now, if we turn our attention to just taking benefits in general, is there a rule, a hard and fast rule that says, well, look, you should really just consider taking it at your full retirement age at, let's just say, age 67, or does it ever make sense to go at age 62? I mean, I have my own opinion on that, which if I get a chance, I'll share that. Or should we always wait until age 70? Should I look at the longevity in the family? I mean, how do you two go about it? It's teaching the professionals on about how to advise their clients in that area, or you too. I mean, you both work with individuals as well. So, do you have a standard rule or?
Nope. No standard rule. We focus on situational Social Security in our class. Okay. That means everyone is in a unique and different situation. If Jim Blair meets with 10 married couples, they're all going to have a different set of strategies and options available to them. When Jim meets with clients, he doesn't try to maximize benefits for a husband or wife. He'll maximize benefits for the family unit. Family unit may be mom and dad, husband and wife. Maybe you need to factor in some young kids. maybe you need to factor in that somebody might have been a public employee. Now, does it make sense to claim at 62 full retirement age or age 70? It depends totally on what the situation is that you're in. If you have a husband and wife, many times it makes sense for the wife to claim her benefits as early as she can, age 62.
Okay.
That might give the husband the opportunity to wait until full retirement age or as late as age 70 to collect his benefits. And this still applies for another 3 months. If he was born by that magic birth date of January 1st of 1954, he can file a restricted application, claim a benefit off of her work record. He'll receive a spousal benefit, while at the same time his benefits grow earning delayed retirement credits.
Okay, so, and this was a big deal. And I can't, was it about 2018?
2015.
15? Okay, it was quite some time ago where they wanted the IRS wanted or Congress wanted to close that loophole. It was a little bit too lucrative.
And then let me tell you about my personal situation, and then I'll let Jim chime in. Okay. So I'm single, not married, so nobody's going to clock off me when I'm gone fishing. All right. I turned age 62 in February of 2018. Okay. I decided to wait until my full retirement age. I was born in 56. My full retirement age is 66 and 4 months.
Okay.
That was June of 2022. So I decided to claim and start my benefits in June of 2022. And I'm very happy I did. There's no guarantee I'll live, there's nearly no reason for me to wait until age 70. Sure. If I live to age 100, I'll be going with my walker into Jim's room at the retirement community. Okay. I'll be talking to him and his wife, Pat. And I'll say, Jim, maybe I should have waited to age 70. But since life is not guaranteed, I decided to take mine at my full retirement age. Okay. I have really good uses of that money, Sev. I can pay bills, pay loans. I can invest that money. Sure. And if I'm inclined, I can pay estimated taxes.
Okay. So that
if I'm inclined.
So that's what you were saying before. It depends on the situation, because when I'm advising clients, a lot of times we'll take it early. Let's say if they're clients that have a pension, and I know that the income is coming in guaranteed, plenty of assets, they've paid off the home, they've paid off the kids and whatnot. What I'll say is that, the missing link here in your plan is long-term care coverage, which is ridiculously costly, the care itself. And so, well, you know what? You don't really need this income. You don't need this $3,000, $4,000, $5,000. I mean, it's nice to have, but you don't need this $3,000-$4,000 per month. Let's call it $3,000 per month. Why don't we take a part of that and we'll pay a policy. So in 10 years, 15 years, you got a paid off policy. Now you've got your care covered. Now you've got Social Security income coming in, your pension's coming in. You got a couple $1,000,000 that's paying, I don't know, 3%, 4%, 5% in dividends or interest or what have you. So I know what you mean, where, it's every situation obviously is a lot of situations look similar, but a lot of them are going to be very different as well.
And let me finally say that people don't know when they're going to wake up, get out of bed, and see the money in their bank account. They just don't know that. So Social Security benefits are paid on either the second, third, or fourth Wednesdays of the month, depending on your birthday. I was born on February 13th. So the third Wednesday of every month, Sev, I get out of bed. I have a skip in my step. I'm singing. I'm dancing. I'm saying, hey! I check my Fifth Third bank account and I see my Social Security benefits in there. So I get paid the third Wednesday of each month.
Perfect. So that's a good thing to look forward to too.
So Jim, I'll let you take it from here, please.
Yeah, and as you were talking, it depends on the people's situation. 62 can be a good time. Oftentimes, if you have a couple that has quite a bit of difference in their ages, the younger one may want to take their benefit at 62 because they may be receiving the survivor benefit before they reach the break-even point of waiting until full retirement age.
Okay.
If you're working, though, and you have earned income, it may not make sense to file because some or maybe all of your benefits will be withheld by Social Security because of what's called the earnings test. The earnings test applies up until you reach full retirement age. At that point, it goes away. So you can file at full retirement age. Do you want to wait till 70? A lot of people do. If you don't need the money, if you're still working and don't need the money, don't want to pay the tax on it, waiting till 70, it's a nice increase. It's 8% a year for each year you wait. It's not compounded, so it's a simple interest, but still 8% is pretty decent.
Right.
One thing for folks that they seem to forget about or not want to take into account, how important are survivor benefits in their planning? So we're looking at the benefit for a married couple, and the Social Security coming in with all their other assets might be enough money where they live a decent lifestyle, the one they want to live. One passes away, now what's left? And the earlier the higher earner takes their Social Security benefit, the lower that benefit's going to be, and the lower the survivor benefit is going to be. So someone might want to wait till 70, even if they don't think their life expectancy is all that long, but their spouse's life expectancy may be. And if Social Security is a big part of their plan for survivorship, they might want to wait because of that. So everybody's situation is different. Just because someone's neighbor takes it at one point and takes their Social Security one way doesn't mean that's good for them. Right. And they need to look at their own situation.
Now that when you're taking it early, there's a formula, but there's a little trick. So this is more for the, let's say, getting a question right on an exam. You can take if somebody's full retirement age is at age 67 and they are going to take their benefits, let's say a year early at 66, they can take the number 12 and divide it by 180, and they'll give that the appropriate haircut, so to speak, in their benefits. Or if you look at, if I'm going to take my benefits 3 years early, I can take 36 months early, divide it by 180, and that's 20%. I'll get a 20% reduction, which is kind of, well, I guess kind of cool. Cool to do on the exam as we're trying to get the answer correct in that roughly 2 minute time that we have per question. So when you take it early, if you're still working and if you're making over a certain amount, you mentioned that you could have it's not a permanent, it's just a temporary reduction in your benefits, or it could be a temporary elimination in the benefits. But once you hit full retirement age, which is the magic number, then we really don't have any negative consequences from taking early. Or if I continue to work at and beyond my full retirement age, I will not have a reduction any longer. Does the administration, I believe, then for that money, let's say that they, for lack of a better term, withheld when you were working and maybe on accident, I don't know, you thought you were going to get your benefits, they will make that up for you over your life expectancy. Is that correct? I mean,
yeah, you have a good handle on that. Basically what happens when you file early before full retirement age, they reduce your benefit for each month that you took it before full retirement age, which you were just talking about.
Okay.
Normally that reduction is permanent. Once you take a reduced benefit, it's always reduced. But if they hold back some of your benefits because of your earnings, they call those credit months. And when you reach full retirement age, they'll look to see how many credit months do you have? How many months did you not receive a full Social Security benefit check because of your earnings? And they'll make an adjustment in that reduction factor. So if your full retirement age is 67 and you retire at 62, that's a 60-month reduction, which is about a 30% reduction in your Social Security benefit. Well, if because of your earnings you receive 6 checks a year, when you reach full retirement age, they would go back and look and say, okay, we reduced your benefit 60 months, but we only paid you 30 checks. So they'll change that reduction factor to 30. Now the reduction, instead of being 30%, is more along the lines of 15%. So you see an increase in your monthly benefit amount. It's a permanent increase for you and your spouse if they step into your shoes, if they survive you. So you will get that money back over time.
Okay, so it just depends, and again, that goes back to the planning. So as an advisor, the advisor has to know, hey, you might get a reduction, or it's nice that we can bring more value to the client when they say, oh, am I going to get if I go at 62 and can I still work? And because I get those questions as well. So, speaking on the numbers, the benefits, are they all completely taxed? I mean, do we get a little bit of a tax break? Is there a certain amount that if we're earning in Social Security, or if we have provisional income over a certain amount? I mean, I guess, when does the tax man come after our Social Security?
Well, I don't play the role of a tax preparer anymore, but we do spend a few minutes in our class talking about taxes.
Okay.
So if you're filing a joint tax return, and your provisional income does not exceed 34,000, I believe.
32,000.
Or how much, Jim? 32,000 or so. None of your benefits will be subject to income tax.
And that provisional income is, well, I mean, this is essentially your gross income plus half of your.
Well, kind of. You start out with the AGI, adjusted gross income, before any benefits at all. I think you add back some adjustments. The most common adjustment will be the add back of tax exempt municipal bond interest income. And there's other stuff like income from Puerto Rico and stuff, but the big one is the tax exempt municipal bond interest income. So AGI before benefits plus the adjustments will give you your MAGI, modified adjusted gross income. And to that, you add 1/2 of your Social Security benefits. And that gives you your provisional income. So that's the figure we're looking at to determine how much of your benefits may be subject to income tax. So if your provisional income is between, help me, Jim, I don't have that. I thought I did, but I don't have that memorized.
Yeah, and that's the same thing because I teach it, and it's one of those areas I've got to look at
between 32 and 44,000. Yeah. I'm just okay.
That's right.
Yeah. It's up to 50% of your benefits may be subject to income tax, and if it's over 44,000, then up to 85% of your benefits may be subject to income tax.
Okay.
Now, these dollar amounts are not indexed for inflation, so every year more and more of your clients, and that means me. And that means Jim will pay tax on our Social Security benefits because these dollar amounts are not indexed for inflation.
Okay. And so I imagine they do that just because, well, I mean, we've got to keep the system going. So who knows?
But what's the good, the bad news, you pay tax. The good news is taxes collected on the taxation of benefits are credited back to the Social Security Trust Fund. So it does make the Social Security Trust Fund a little more solvent.
Okay.
Not much, a little more. I blame me. I'd rather them not pay tax on my benefits just to have that go into the Social Security Trust Fund. I'd rather keep that money.
Right. But then at least we know it's being shored up to a degree.
But it's being reported to the government.
Okay. No way around that. I'm sure.
No way around it. My income is reported to the government.
They grab that right away. And then, as far as, if I'm 60 years old, I decide, okay, my wife and I, we're going to have another baby. She's much younger. Now I've got maybe a couple or a few kids. And on top of that, I'm taking care of my mom or dad. They are dependents. I mean, did I just hit the lottery there? Can I pull in $20,000-$30,000 a month in Social Security benefits? Because it's myself, my wife, and 2-3 kids, and I'm taking care of mom, dad. I'm taking care of her mom and dad as well. Or is there a maximum dollar amount that, that's it, you're capped and no more?
Yeah.
There is a family maximum applied to each individual record. There's a term called PIA, primary insurance amount. Basically, that's your benefit at your full retirement age. The family maximum is going to be somewhere between 150 and 185% of your PIA.
So almost double. We can almost.
Yeah, I guess you could say. And so what that means, first of all, the number holder, the person on whose record benefits are being paid, they always get their full benefit. They're not subject to the family maximum, but their benefit is included in that number. If you have just one other person, your spouse is receiving on your work record, you're still not going to meet that family maximum. But if, as you said, you had a child or two kids, then particularly if you have two kids, they're going to hit the family maximum. If it's your spouse and a child, or your spouse and two children, or three children, or four children, that their benefit is going to be divided on your family maximum less the worker's PIA or full retirement age benefit, and they'll just divide it up evenly among them.
It's split.
Now, parents really doesn't help you out any, but the kids will bring more money in. Try not to have more than two, because you're not going to get any more money. Or if your spouse is eligible, don't have more than one.
All right.
I wouldn't call that hitting the lottery. Thinking at this age of having little rugrats running around.
So my dream of having $30,000, $40,000, $50,000 a month coming in from Social Security, that's out the door. Okay. So we got that.
Jim, why didn't you address the other question Steph had about parents?
I mentioned real quick, but the parents, they're not going to be drawing off of your work record unless you pass away. There is a parent benefit if someone passes away, if they were providing at least one half of the parent's support. Then there is a parent benefit. You don't see it very often because most of the time the child's not providing at least one half support. But if they are, and the child passes away, the parent could then draw benefit off of their work record.
And this just might be a in the weeds to CPA question, but I mean, do you know how they figure in, what support is? I mean, is there a national number that says, hey, if you pay more than $2,000 a month to take care of mom or dad, that this is considered half a support? I mean, that's not a Social Security question. I was just curious if any of you knew, how they determine half of support.
Well, I would assume that they'll look at all of the expenses for the parent.
Okay.
And then they'll determine how much of that is coming from all different sources, like retirement benefits, distribution, interest, dividends, capital gains, Social Security benefits, corporate pension, stuff like that.
Okay. Yeah.
I'm sure that's kind of how they do it. How you compute support, that's another question, or what's included in support, that's a slightly different question.
Okay. Yeah, that was a little bit off the wall. I just figured. And so the last topic, if you both don't mind, it's when it comes to disability, if I'm disabled before a certain age, and I don't have I almost said quarters of coverage, which I'm so used to saying.
I know. Everybody is.
The technical term, but because if I don't have those credits of coverage, those 40 credits, can I still qualify for disability? And let's say I don't have those credits, and then I hit the age of 62. Do we switch from disability to Social Security retirement? How does that work?
Yeah, the easy one to answer first is if you're receiving disability, it switches to retirement at your full retirement age. Not 62, but full retirement age.
Now let's say if I'm 23, I never worked. I had a couple part-time jobs maybe, and then unfortunately I become disabled at the age of, I'm just going to say 23. So I certainly don't have my credits, not even close to it. So am I at 62? I am picking up retirement income. It's treated as retirement. It's no longer disability at that point.
Not 62, but full retirement age.
Oh, at full yes, sorry, right. At full retirement age. Okay.
Right. Now
I would be considered getting disability until let's say age 67 or whatever my
Right.
full age is. Okay.
Right. And the young folks, folks under 32, they don't need necessarily the same credits as the folks at 32 or older. If you're 22, you need a minimum of 6 credits, and they'll use a minimum of 2 years to compute your benefit. Once someone's 30, and then that works itself up until age 32. And then at that point, you do need your 40 credits. You also need to have worked 5 out of the last 10 years, meaning you have 20 credits in the 40 quarter period before you became disabled. And you have to meet both of those requirements. And if you do, then you would be eligible for a disability benefit. If you start receiving, depending on your disability, you could receive that the rest of your life. It's just when you reach full retirement age, it's converted to retirement. Your payment is the same. Your payday is the same. It just means you don't have to worry about Social Security doing a review and saying, oh, looks like you've recovered. We're going to terminate your benefit.
Okay. Yeah. And that's, as you mentioned that, I watched something, I think it was on Netflix, and I think this guy was a Social Security disability attorney, and they were working the system. I don't know if this sounds familiar at all.
Oh, yeah, it sure does. West Virginia.
There you go.
Oh, yeah. Believe me, it probably wasn't Netflix. It was a CNBC American Greed type of documentary.
Okay.
Where they talk about this judge in West Virginia that was kind of working in cohorts with an SSDI lawyer. And it seemed like all the cases from this one lawyer that went to this judge was approved right away.
Right. Yeah.
So how that happens. So anyway, it was kind of all caught. And I don't know what repercussions happened, who went to jail, who resigned. But yeah.
I think they got both thrown in jail. The attorney, I think, run. But, the bad thing about, I know it's not related to the discussion, it was somewhat interesting. But I think the bad thing is about it, they were highlighting in that show is that, a lot of the people that actually really did qualify, because I think the government came in and just almost carte blanche just said, okay, everyone that had any exposure to this guy, you're not getting benefits. And so I think they had some good-hearted attorneys come in and do some pro bono work. So I listened to that in the car. I listened to it in the car. I'm praying again, maybe 2 weeks ago. It came up. Yeah, so it's well, I mean, if anything, it's just it paints a little bit of a picture, at least for those listening, as far as Social Security and SSDI and so on. But anyway, I think we covered quite a bit. Gentlemen, I'd really like to thank you, for taking your time to be on the Earn Your Marks podcast, for sharing some of the immense wealth of Social Security knowledge that you both have. I'll certainly be sure to include your contact information in case anyone needs your help or wants to learn more about Social Security planning strategies or certification. If you wouldn't mind, would you just give us again just a brief rundown? Name of your company and the organization that you're both with.
Sure.
And how you help the individuals and the advisors out there.
So our company is Premier Social Security Consulting, LLC. We're based out of Cincinnati, Ohio, and we provide 2 services. One is Social Security Consulting. So when folks across the country or when advisor clients have questions about their Social Security benefits and strategies, we can do a consultation there. Also, we educate. We educate advisors across the country, and we offer the National Social Security Advisor Certificate. 5,000 advisors have taken our training. 2,700 certificates have been awarded since 2013. We provide our class 3 ways: live in person, live webinar, and taped on demand video. And to get more information about our classes, you can go to our website, which is premiernssa.com. That's Premier Nancy Sam Apple.com. You can send me a quick email, mkiner, Kiner, at mypremierplan.com, or give me a buzz. Direct line, 513-247-0526.
Great. And I'm going to have that in the description below so the listeners can just click those links or call. And for those listeners that will be taking or are thinking of taking the CFP exam, if you haven't done so already, be sure to subscribe to our YouTube channel, which is at Pro Exam Tutors, for videos on other exam-related tips and topics. Also, if you found this information to be helpful, please let me know with a like and a comment. I always love hearing from you guys. And if you know someone that can benefit from this knowledge, which there is a ton of it here, please be kind and share this with them as well. Once again, Mark and Jim, thank you. Hope to talk to you both again soon in the future.
Thank you. Had a great time.
Yeah, likewise. Take care.
Thanks for listening to this episode of the Earn Your Marks podcast. For more information or to get in touch, visit us at proexamtutors.com.